FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
We're back on the Financial Survival Network, and this is Kerry Lutz. Can't stop talking enough about what happened last Thursday to the price of gold and silver for good reason. It was so unexpected, and then it happens on the FOMC week where the Federal Reserve is meeting. Janet Yellen is spouting out her never-ending stream of Fed speak, and we've got John Rubino of dollarcollapse.com here to do a post-mortem. John, how are you?
Kerry, I lost you there.
John, how are you?
Oh, great, Kerry. How are you?
All right. So what'd you think here? The action in the precious metals, that all but forgotten, unloved sector of the markets here that everybody has just literally chosen to ignore.
Yeah, last Thursday was the kind of day that the gold bugs have been waiting for a really long time. You know, gold and silver both popped, and it took the mining shares along for the ride, and then some. You saw a lot of miners go up by double-digit rates in one day. And see, really, this is the kind of thing that, based on fundamentals, should have been happening 3 years ago when we really started taking on all this debt and pushed interest rates down to zero. That's the kind of environment where precious metals ought to rocket, and they didn't. And so the wait has been excruciating. But Thursday gave a taste of what things will be like when the precious metals bull market gets going again. And there's no way to know whether that was the beginning of the return of the bull market or just a taste, and we're going to have to wait for another few years for it. But technically, you see a lot of charts out there where gold and silver have just burst through their long-term moving averages. And now have the kind of technical profile that implies that we might be headed for a sustained up leg. And if that's the case, the mining stocks, especially the juniors, are so beaten down that they will go up 2 or 3 times the rate of the underlying metals. So we'll see just phenomenal increases in the prices of a lot of these little beaten down stocks. And the people who are patient enough to hang in or prescient enough to start buying at the bottom are going to make a ton of money. And that tends to be the way these markets go. You know, you lose money and you lose money and you lose money in junior miners. And then in 1 year, you make it all back and then some. And so it would be really nice if 2014 was that year. We can't know that until we see it happen. But it's coming, and it's just a question of when.
Yeah, I know they got very volatile and shot up on Thursday. But look, John, from the end of November to the beginning of January, the whole complexion of the precious metals complex changed. And you felt it. The declines became much less volatile because all of the weak holders had been shaken out. And even when there were bear raids, whatever you want to call them, whether you believe in manipulation or not, when there was a decline in these markets, it would be in gold, $10, $12, at the most $15. You didn't see $30 hits. And the most they could get it down to was $1,180 or so. And then after the first of the year, went over $1,200, didn't go down below $1,200 hardly at all, maybe once. And it just steadily started going up and up and up. And mid 1200s kind of became support, and then boom, along came last Thursday, and up it went. And will it go below 1300 again? It wouldn't surprise me, but to me, that was just a confirmation on Thursday. That wasn't a real change in the trend of the market.
Yeah, the underlying reality of the precious metals market is what has been very interesting. We're in addition to the price action, where the Western central banks and the big bullion banks that they work through have been continuing to try to force precious metals prices down. At the same time, you've seen India and China and Russia sitting down there at the bottom, just being willing to buy all the physical gold and silver that were available at these new lower prices. So we're building up a supply imbalance where there really isn't enough precious metals left in the West to continue this game for very much longer. Meanwhile, in the East, they're still ready to buy. And so at some point, the manipulation ammunition starts to run out. And I think we're nearing that point. And the price action in precious metals kind of implies that the amount of gold and silver flowing from west to east is starting to sputter a bit. There just isn't unlimited metal available to satisfy China's appetite. And the longer this goes on, the greater the imbalance becomes, and the larger the upside potential becomes for gold and silver once Western central banks decide that they're not going to sell anymore, and they're not going to play the games where they lease gold to the big bullion banks who then dump it on the market. When that game ends, or when it even slows down, then we'll see huge upside for gold and silver. And this is what it's going to feel like. This might not be it, but it's going to feel like last Thursday, where you get these huge gaps up, and everybody starts paying attention, and then the mining shares go along for the ride, and that's going to be our reality for the next few years in precious metals. And the only question is, where's the entry point? When does it begin? And it would be very nice, as I said, if this was the beginning. And there's no way to know whether we have another leg down because the central banks decide to do another raid where they dump even more gold in the market and force the market even further down. That could happen easily because it's not in the Western central bank's interest to see gold go through the roof, because that basically makes their currencies look bad. Gold is a form of money that competes with the dollar and the euro and the yen to an extent. And when gold goes up, it makes those other currencies look bad, and by implication, it makes the people running those currencies look incompetent. So it's not in the West's interest to see gold go up, but they're reaching a point where they don't have the ability to stop it. And so,
and all you need to start seeing is increased demand for precious metals in the West also, and it's kind of game over because they might be able to manage the price with demand only coming from the East. But if there's demand in the West as well, it's kind of game over. And I had on Julian D.W. Phillips. He's been in precious metals for 40-odd years, and he's in South Africa, so he's not really tainted by bias of being in the West. And that's what he said has happened. You don't have supply coming from the West anymore. He thinks that the ability of the West to meet the supply demand from the East is diminishing. And then he says he thinks people are waking up, and he thinks you're going to start seeing increased demand in the West for gold and silver. And that's all it takes. Probably just alone, the West not having the supply to meet the demand in the East would be enough. But then once the inflation starts kicking up and these hedge funds say, wait a second, we thought there wasn't any inflation. They've been telling us there's no inflation. And I'm using inflation in its modern definition, which is higher CPI, as rigged as the CPI is. I'm not using higher money supply, or really the money supply now is credit, availability, total credit in circulation. Once that starts happening, forget it.
Yeah. And when even the government's distorted consumer price index starts to rise at an accelerating rate, then it is game over, because people are going to start looking around for ways to protect themselves. Right now, all of a sudden, just in the last year, consumer prices have begun to hit Main Street in a serious way. Food prices are way up, and gasoline is approaching a record. And these are the things that people notice. Healthcare costs are harder to figure out because you've got insurance and your copay and everything, and you just don't know what you're paying. And college tuition is something that only applies to people with kids in college. So when those things go up, it hurts, but it's harder to generalize to the rest of life. But when food and gasoline go up, then you know that there's inflation as it's defined, as you said, in modern terms. And that's the reality out there right now. And the other thing that's interesting is that the assets normally bought by the super rich when they have extra money, in other words, when there's an inflationary environment, have all gone through the roof, except for gold and silver. So you've seen London penthouses at record levels and fine art at record levels and equities through the roof and high-grade bonds at the highest they've ever been, as they're the flip side of interest rates. So when interest rates are way down, bond prices are way up. So you've seen a bull market in bonds for the last 20 or 30 years, which accelerated lately. And all of those things are through the roof. But gold and silver, which are normally in that class of things that rich people buy as a way of protecting the wealth they've already accumulated, they're not up yet. So that's another reason for us to expect a serious snapback in precious metals prices, because they would just join their normal cohort. You know, they would just go up to the point where they match London penthouses or blue chip equities or whatever. And so that adds to the pressure on precious metals going forward, because if we're seeing inflation now and people start to look around for inflation hedges and individuals start buying gold and silver coins and things like that, that's a signal to the super rich of the world that this is the asset class that they should be focusing on. So we could see phenomenal buying pressure going forward when you look at it that way, because just take 1% of the financial assets that are out there and let them flow into these little thinly traded small precious metals markets, and those things will react like rockets. You know, silver could be gapping up by $10 a day when this thing really gets going, and gold by $100 a day easily. And that's going to be fun, but you have to be in it to participate in it now. You know, you can't wait for that to happen, because it'll happen very quickly, and it'll surprise a lot of people because it'll happen on days when you don't normally expect it to happen. So we're at the point now where you have to be brave and start buying this stuff, even though you know it's performed badly in the last few years, and you know it could have another down leg, but it also could have a parabolic rise that comes out of nowhere.
You had to be brave, like you had to be brave in 2008 when the price of gold went all the way from 1,000 to 680, and the price of silver was, what was it? I think it went all the way from 12 down to $8 or $7.
Oh, I remember those days well, Kerry. I had a bunch of junior mining stocks that went down by 90% during that time.
That's the brave you have to be.
They all came back within 3 years. They were way above where they started in the 19. Yeah. And so this is probably going to be that again, which is, that's another part of the story, is that we're making all the same mistakes that we made back then. You know, we're repeating the mistakes of 2005, 2006. It's as if our institutional memory in the global financial system has just compressed down to next to nothing. You know, we can't remember 3 years back or 5 years back.
And we'll talk more about repeating those mistakes when we return on the Financial Survival Network.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter, The Financial Survival Network. It's all about what's next.
We're back on the Financial Survival Network. We're talking with John Rubino of dollarcollapse.com. So how do you avoid repeating those mistakes of the past? Because, Warren Buffett says, buy when there's blood in the streets. And really the time when there was blood in the streets, John, was a year ago, not now. Really the situation has stabilized. When you look at the chart, it's been pretty stable, kind of doing a channel or a wedge during this time. Now the wedge has been broken. So from a technical standpoint, your downside, other than if you listen to Goldman Sachs's report, which said it was going down to 1,000, right? And according to somebody I spoke with, I think it was James Rickards, he said that Goldman Sachs didn't even believe it. The traders didn't believe it, but the research department, that's what they put out. But the trading department was ignoring it.
Yeah.
Right?
Well, Wall Street to an extent has the ability to make these predictions a self-fulfilling prophecy if they want to. They can manipulate these markets lower. And there's no reason to think they can't do it again, except that the big banks, by and large, are long precious metals now. They beat gold and silver down, and then they went long, and so it's in their interest for it to go back up for a while. And once it spikes, let it go. Let gold go up a couple of $100 an ounce, and then they will swap out of their longs and go short again. So that's a game that's being played independently of the fundamentals. But the fundamentals keep getting better and better. And at some point, these big institutional shorts are just going to be run over by global demand for precious metals, and then we'll see a short squeeze where they have to close out their bets against gold and silver, and that's going to add to the buying pressure. And that's out there too. There's no way to know timing-wise. But I think as far as blood in the street goes, there is still serious blood in the streets, and certainly in mining stocks. You can think of it as congealed blood by now, because it got spilled a couple of years ago, and now has just been sitting there. The mining stocks have really not done anything in the last couple of years, and so many people who were once fans of that sector have gotten disgusted and moved on. And that's the kind of condition that is ripe for a really nice snapback, because you got all the weak hands, as you said, are out. And the people who are in it now tend to understand it. And they aren't going to sell for a 10% increase or a 20% increase in a lot of these stocks. They're holding on for 5 baggers or 10 baggers. That's their target. And so they just won't be ready sellers when a recovery gets going. And so you only have buying pressure and very little selling pressure for the next 300 or 400 points in gold, and for the next 100% or 200% increase in a lot of these mining stocks. So again, once it gets going, no way to know when it does get going, but it's going to be spectacular when it happens, just like 2009, 2010, 2011 were. And so, in a sense, we're making all the same mistakes at the macro level in the global financial system, but we've also created a lot of the same opportunities. Our mistakes of the past few years are going to lead to the same opportunities that we had in 2008 to get into mining stocks at incredibly cheap levels. So in that sense, this is a hopeful story. It's a little bit frustrating to see the same process at work over and over again, and to see individual investors get fleeced the way they do when the big players bid up equities, for instance, and then start selling to individual investors at the peak. Where a lot of people are going to get hurt because their pension funds are getting into equities at exactly the wrong time, and they've been convinced by their stockbrokers to do the same thing. So individuals are going to suffer here, except for individuals who buy the things that have been beaten down already, like precious metals. They're the guys who will make.
Yeah.
They're also a small minority. You don't get that kind of advice from a standard issue stockbroker or financial planner. And so the average person has to figure this out on their own. They aren't going to walk into their financial planner's office and have the guy say, all right, now we should shift you completely into mining stocks. You'll never hear that.
Yeah.
And so you got to make your own decisions with these things.
Yeah. And got the mining stocks. Some of them even have dividends, although they've been cut. And we don't make recommendations, obviously. I always say, don't listen to me because you'll definitely lose money, at least in the short term. But compared to look at the PEs, every measurement, I mean, there's some stocks that even fall into what Benjamin Graham called net nets, where they're selling for less than the cash that they have in the bank. I mean, it's just remarkable what's out there. So you have to do your due diligence, your own due diligence, and you have to really examine this market like you've never have before to come up. But you can pretty much safely say that any company that is producing silver and is making a profit and made a profit for the last couple of years, like First Majestic and Fortuna Silver. Okay, and we're not recommending them, but just as an example, those companies are enormously profitable, continue to increase their output of silver. They're pure silver plays. And, they're still standing, right?
Yeah, there are actually some companies that are still making money, even at these extremely low prices based on recent history. And that leads to kind of an interesting strategic question when you want to get into mining stocks at this point in the cycle is, do you go for the highest quality companies first because they're the least risky. And that means if you buy them, then if your timing isn't quite right, they're going to survive and they'll still go up even if you lose money in the next couple of years. Or do you go for the lottery ticket stocks that are a little dicier? They're not as high quality in one way or another, either financially or in terms of the assets that they've got or in terms of management experience. But they will rocket if you're right. You time it right, these things are like lottery tickets. They're like options where they'll go up 10 times in a year, while gold and silver go up 30, 40, 50%, or maybe double in the case of silver. And so how do you want to play this is really the question now. Not should you play it, but how do you want to play it? Do you want to be conservative and buy good quality stocks and still make money and be reasonably safe? Or do you want to go for the lottery tickets and make massive, massive profits if you're right about the timing? And my advice would be to kind of mix and match. Buy a few lottery tickets, but mostly focus on the good quality stocks. And then you'll still make a lot of money, but you'll be able to sleep at night. But it comes down to your own temperament. How do you like to play markets that are seeing their time come?
Yeah.
And that's an individual question, but it's an interesting one, and it's a fun one because it's nice to finally be in markets where you think you have a good chance of making a lot of money going forward.
Yeah, exactly. Don't be a reckless gambler. Better off going to the casino and laying your money down on the table there. Don't be a reckless gambler, and don't forget the physical, because you never know what's going to happen to the paper markets out there, systemic breakdown wise and all that. Just because they haven't broken down yet doesn't mean that they won't in the future. And obviously we're not saying that they will, but you have to be prepared for anything here, John. Right? Who knows what's going to happen?
In precious metals, the mining stocks are for your risk capital, because there's a lot going on with them that really has nothing to do with precious per se. Mm-hmm. And everybody should own some real money as part of the cash portion of their portfolio. And real money is gold and silver. It's not dollars and euros and yen. Those things are fictitious. They aren't real money in any sense of the word. They're just payment systems, basically. So, keep some dollars on hand to pay your bills, because there are certain things you can't buy with gold and silver. But the money, quote unquote, part of your portfolio should be in precious metals, because those are the real forms of money that have stood the test of time. And these fiat currencies were really experiments. Starting in 1971, we decided to see what it would be like if we had national forms of currency that weren't based on anything real, and that only held their value to the extent that we trusted the guys in charge to manage them prudently. And obviously, when you hand that kind of money or that kind of power to a government, they're going to abuse it. And across the board, all the major governments of the world have abused the privilege of their printing presses. And they're in the process of destroying the value of these fiat currencies. So do not put your life savings in a bank account denominated in dollars, or a bank CD, or dollars under the mattress. Those are really bad ideas.
Exactly. And on that note, we will catch you next week, John. Find John's work at dollarcollapse.com, and don't forget his book, The Money Bubble. Go to financialsurvivalnetwork.com. You'll find the link to John's site and sign up for our free newsletter. John, we will talk with you again next week.
Great, Kerry. See you next week.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.